Welcome to the first instalment of the course, Why Do Prices Go Up? To start, we'll be looking at the Consumer Price Index and seeing why this is important in understanding why prices go up over time. I think what's important to start with is to ask ourselves, why do prices not stay constant over time? Why do they have to move? Why do they have to go up, and why can't they go down? Especially when you get big incumbent companies that find cheaper ways of manufacturing their goods, such as technological innovations, and you also get new entrants into a lot of sectors that will drive the prices down. And you can think of Lidl and Aldi's in the supermarket sector as ones doing this in the UK. So why do we observe prices going up year over year? And a lot of this has got to do with the central banks. They have an inflation target of 2% per annum, which means in general they want prices to go up 2% every year. But why 2%? Why not 1%? And why not 0%? Because if prices are constant, it's a lot better for budgeting and planning for households and companies, isn't it? Economists would probably differ on the true definition of inflation, but the bottom line with this is that inflation is a permanent loss of purchasing power. Once you go through a period of inflation, you don't get that purchasing power back. It's gone. The currency has debased. And the rate of inflation shows you the speed in which the currency is depreciating. We measure inflation using what's called the CPI, and this is the Consumer Price Index, but a lot of market analysts and economists would call this the CPI. And this is based on the fact that the CPI is formed through measuring a basket of items. They see the price of these items in one period, they wait for some time to pass, such as a year, and then they will look at the prices again. And the change in prices gives them the inflation level. But the problem is that they constantly take goods out of the basket and put different goods in. So it's like you're measuring something that's changing over time. Which isn't necessarily a problem, because what we purchase changes. There's different trends and different items become available. So it stands to good reason that the items in a basket are changed. But when you look at some of the reasoning behind the items, if you look at in 2020, car batteries was removed from the basket. And the reason that they gave, and this is a direct quote from the Office of National Statistics in the UK, the car battery was chosen for removal based on availability for price collection. Which is a little bit strange, because they was quite happy to get prices in previous years, but all of a sudden in 2020 they decided they couldn't get enough prices, so they had to drop it from the basket. But does the CPI understate inflation? And this is the key takeaway point from this. The CPI is what the government tells you inflation is. Some governments have every intention of understating inflation, because high inflation looks like the economy's not managed very well. And also some things such as welfare payments are tied to the rate of inflation. So the higher inflation, the more the government has to pay out in welfare payments. So it's in their interest to keep welfare payments low, which means keep inflation low. This is very interesting, because if you take the year 2000 as a base year, and you apply the official rate of inflation annually, and you do that every year until 2021, what you will find is that sterling has debased by 36% in those years. And basically what this means is that in 2021, it takes £1 to buy the same amount of goods that 64 pence could in the year 2000. And just to show how gold is an effective hedge against inflation, on New Year's Eve in 1999, the gold price closed at £170 per ounce. And New Year's Eve 2021, we're looking at £1,351 per ounce. So it's a massive increase, and you can see how sterling has debased over this period. But when we talk of inflation, they tend to think about rising prices, but inflation has a similar effect with stopping prices from falling that should have otherwise fallen. And the changes in the general price levels The flow of goods per person, if that remains constant, then any change in the price level will be down to the flow of money. So if the money supply is increased, that will change the price levels, even if the goods stay constant. But if the money per person in an economy stays constant, then it will be the amount of goods and services on offer that determine the price level. So when we look at central banks with their 2% inflation target, a central bank can't influence the amount of goods that companies are offering to the market. So to have a 2% inflation target, they have to target the money supply. And if we look at something that's known as the equation of exchange, it's not really important that you memorize this and truly understand it. But what this shows is that on the left-hand side of this equation, you've got the money supply and the velocity of money, and they effectively set the price level. So we talk about the money supply, the amount of pound notes in circulation, and the velocity of money is how quickly this is being spent in the economy. And this is quite important because there is a velocity factor. And this passage is taken out of the book, The Economics of Inflation, which is a study of the post-war German economy. And it says from 1914 to 1918, the money supply increased quite a lot, but you didn't see the prices react the way that was predicted given the expansion of the money supply. And a lot of this was down to hoarding, because the German people was uncertain of what their future was going to be like, so they were saving money. But not only that, they thought that after the war the Deutschmark would go back up. So what you saw was that the central bank was churning out a lot of money, but it wasn't being spent, so you didn't get that big increase in price level straight away. And the opposite end of this scale is places like Venezuela and Zimbabwe, which over the last decade or two have seen hyperinflations. And the reason for this is obviously the money supply increased markedly, but also people realised that the currency was losing its value very quickly. So as soon as they got the currency, they were spending it, and that exacerbated the hyperinflation. And again, if there is a takeaway point from this presentation, it's that currencies are unstable. We see the pound as stable. If you have a £20 note in your pocket, it appears to be the same £20 note that you had in your pocket 10 years ago, but it's not a fixed asset. This changes all the time in terms of what you can buy.